If you can keep your head when all about you are losing theirs.
If you can trust yourself when others doubt.
What possibilities might you see?
If you can meet with triumph and disaster.
And treat those two imposters just the same.
If you can see it, the world is yours to trade. See it, IG it.
A very good afternoon, depending on where you're joining us from. Welcome to a very special pre-US election edition of Bloomberg Live. My name is Heidi Stroud-Watson. I'm the anchor of Daybreak Australia and Daybreak Asia on Bloomberg TV. Before we kick off today's proceedings, I would like to begin by saying that Bloomberg does acknowledge the traditional owners of the country on which we meet today. I'm currently on Gadigal country in Eora Nation, and we recognise their continuing connection and contribution to land, waters and culture. We pay our respects to their elders, past, present and emerging too. Before we get to our very full and fascinating lineup of guests and views today, I just want to get some housekeeping matters out of the way first. In terms of operationally, make sure you're using Chrome or Firefox to view this event for the most optimal effect. If you're having any issues with sound or playback, you can just refresh your browser and that should be able to fix that. The size of every window you see in front of you is also movable and resizable if you want to customize that to how you like it, and you can restore those windows as well by using the buttons at the bottom of your screen. All right, today's session, of course, is very much a virtual one. It's also very much an interactive one, and I would really encourage each and every one of you to participate. You can do this by responding to our polling questions, our audience poll, as well as asking any burning questions you might have for any of our guests, as well as our stocks reporter joining us today as well. You can submit those questions using the Q&A box that you can see on your screen, and also those polling questions will appear in the slideshow for you to answer as well. And of course, as always, we do invite you to join in on the conversation on social media, on Twitter or your preferred choice of platform there using the hashtag 2020Impact. You can always go back and watch this whole session again on YouTube as well at your leisure. Well, this brings us to the first of a very full and fascinating lineup over the next hour. The session is presented with the grateful support of our sponsor, IG. You can check out the resource centre in the window in front of you as well to download more information on their market outlook. And you can also find out more details about the other events in this series. Coming up on the 18th of November, we take a look at the outlook for emerging equities. Well, with less than 2 weeks until the US presidential election, the stakes, I think it's fair to say, have never felt higher. The implications and the potential for market volatility, as well as geopolitical volatility for the global economy, for trade, for security, technology, and of course, as we are still in the middle of a global pandemic, for healthcare, have really never felt greater. And all of this, of course, taking place against a backdrop of a threat of economic and technological decoupling, of deglobalization, all of these themes that were already with us before even the onset of COVID-19, before any of us had really thought about a global pandemic as a daily reality that we'd have to deal with. And all of these, of course, really just exacerbated now by the fact that there is a pandemic. Global markets, in the meantime, continuing to be supported with a mix of government stimulus, of course, across most economies, as well as truly extraordinary central bank monetary policy. So how long can the rally last? Does the market really care who ends up in the White House after November 3rd, or after January, I should say, next year? Is a clear-cut result, an uncontested transfer of power? Is that more important for asset prices than it is the individual policies on taxes, on jobs that we might actually see? What about stimulus? Has the market already priced in generous stimulus, and are we poised really just for disappointment regardless of what we get from these ongoing and drawn-out negotiations? What are the implications of a Democratic or Republican policy when it comes to inflation, when it comes to growth differentials? Where does the dollar go from here? And how does all of that play into the outlook for non-US assets, including Asian equities, which we're here to talk about today? So we'll be doing our best to get you some answers to at least some of those questions today, and we'll get the ball rolling now with a message from our sponsor, IG, and their Asia market strategist, Jingyi Pan.
Good day. Thank you for joining us at this virtual event in Racing for the US election sponsored by IG. No one can say that perhaps been little rest for all of us. Even though we probably spend more time at home this year so far, more so than most other years, and no thanks to the global pandemic. But while the COVID-19 implications continue to linger, the event we stepped into 2020 had probably been this US election, which we are looking forward to this November 3rd. Now, I'll recall approximately 4 years ago in 2016, there had been one shock after another in the form of the Brexit surprise, and later with the shock win with President Donald Trump taking over the White House, and certainly brought about very interesting 4 years so far. This had been both for the US economy and global markets as well, with populism, deglobalization, and political uncertainties, some of the often heard themes. Now, while COVID-19 remains the overarching issue that countries and markets around the world remain grappling with, this interlude in the form of US election has suddenly eclipsed our attention. Now, in terms of the implications, the broad expectations stepping into the event itself have been one aligned with Democratic nominee Joe Biden being US market negative. This on account for the potential for higher corporate taxes, among others, and Asia equities FX friendly with hopes for less aggressive stance on foreign policy, including trade and with China. Exception, however, is with the likes of infrastructure-related sectors and certainly clean energy, as we see the iShares Global Clean Energy ETF saw alongside Biden's lead in polls. On the other hand, a moderately positive situation with Trump is expected for the US market on continuity and not to mention other forms of fiscal support down the road. The legacy with starting trade wars with key trading partners, however, does not intuitively put Asia region in a good light with another 4 years to go. Of course, all of this will have the Congress situation to play a part in terms of the likelihood for the party plans to be carried out and may see to varying degrees of market reaction. Evidently, the latest election had also been viewed with a different lens as to whether a contested election would be the case. Signs have presented themselves that any narrow election outcome not in the favor of the Trump camp may be one of many triggers that could invite the materialization of a contest. The assessment of such a scenario had invoked fears of uncertainty, political instability, and possibly civil unrest that are all negative for risk, sentiment, and assets alike. So around the election results, this may be one fuse that remains lit. Safe to say that so far the lead seen by Democratic nominee Joe Biden had only been viewed as positive as risk assets were picked up in tandem with the polls ahead of ongoing earnings season. Many had looked to the likes of offshore yuan, the Korean won, the Taiwan dollar, which we've been tracking on IG, has certainly led the pack in terms of gains against the US dollar between mid-September and mid-October to the tune of 1 to 3%. Now, with hope and luck, we avoid a situation of a shock result this time round. But certainly, counting on the hedges should the luck run out here. Now, with all that being said, let us also remind ourselves this US election is important for the trajectory of the world's biggest economy in the next 4 years at the very least. But let us do also allow the conversation to carry past this event that seems to be eclipsing markets from Asia to the US right now. Trends that we've noted across markets, whether this is in the US or here in Asia, the strong Taiwanese or Japanese markets that clients have taken an interest to have taken a breather in the lead up to the US election. The recovery from the COVID-19 pandemic, however, remains underway. With the passage of the political event, the focus remains on growth and certainly keeping a close eye on the likes of the Hong Kong and local Singapore market that seems to be lagging some of our other counterparts. All in all, it will no doubt be an eventful couple of weeks in the lead up to the November election and perhaps well after as well. And with that, on behalf of IG, we're glad to have this US election virtual event, the expertise gathered to navigate the perhaps choppy waters ahead. Now back to you, Heidi.
Clear Pan there from IG Markets delivering just that introductory speech there. Let's get to some of the views that we've gathered for you today. Joining me out of Denver, Colorado is Brian Barish. He's the President and Chief Investment Officer when it comes to Cambia Investors. Cambia has $10 billion under management. He joins us to give us a view less than 2 weeks out from the November 3rd vote stateside. Brian, we've been kind of coasting along in expectations that this widening lead for Joe Biden is looking comfortable. But after Brexit, after the last US election, I think there are a lot of people, let alone investors, who said that they'd never pay attention to another poll again. Are you assuming that there could be a potential upset again this year?
In the U.S., the amount of polling error that you would need for Biden to lose as compared to when Hillary Clinton lost would be higher. Biden's ahead by 7 to 10% nationally. Now, I do think that there is kind of a stealth Trump vote. These are people that they won't say they're going to vote for Trump because it's unfashionable, but they like him. And that's anywhere from 3 to 5 percentage points, depending on the state. So it's still possible, but it would be really outside of any kind of normal polling error type of range.
So, which leads me to what you say is the most interesting scenario, maybe not the scenario that a lot of people would want in terms of the clear-cut result, but that would be a Biden-Harris win in the White House, but Republicans retaining control of the Senate. What does that mean for markets potentially in the sense of the ability to come to policy decisions?
It means there won't be a lot of policy decisions. That's basically what it means. I think Biden with the Democratic Party as it's currently constituted is a little bit of an unknown. This isn't the old Democrat Party. It's infused with a much more rambunctious, radical left wing. There is a centrist component to the Democratic Party also. It's just not very clear how they would legislate, how they would run the country. But generally they seem to be in favor of very aggressive taxes, which are not a real good prescription for an economy that is trying to recover from a devastating impact. If Trump were to prevail, how does Trump govern in a second term? I'm not going to speculate on that. But if you have a Biden White House and a Republican Senate, generally that means very little happens. Now, that's good for markets in the long term. In the short term, there seems to be a built-in expectation of what I would call big fiscal, and that would be much less likely with a split government.
Right. So we'll talk about big fiscal in a moment, but let's talk about monetary because, there's a part of me that certainly thinks, well, it doesn't really matter who's in the White House. It doesn't really matter because these seem like markets that are running on the fumes of the Fed, right? And we know the Fed is probably not going anywhere in the medium term. So is that still the biggest play here, the power put, if you will?
The Fed has proven beyond a shadow of a doubt the phrase "don't fight the Fed" with respect to markets. Monetary policy has been super aggressive. The Fed has practically doubled its balance sheet, and if you want an explanation, why is the U.S. stock market actually up year to date? That's it. It's just very powerful to have the Fed continuing to pump as much money into the system. I think the Fed continues to do this, ironically, until we get a vaccine, until we begin to have a more normal state of affairs. And I'm not able to predict with precision when that's going to be, but most people seem to think it's going to be in the next 2 to 6 months. Ironically, that might cause the Fed to pull back a bit from what's been hyper-aggressive monetary policy just to keep things afloat while we wait out a medical solution.
So I've got to ask you, Brian, do you think there's a level of moral hazard at play here in terms of how policy is impacting investing decisions? And I want to go back to what you said about big fiscal. Does that side even matter now? Because it feels like maybe asset classes are priced for disappointment as opposed to being able to get much of a leg higher, even if we do get a stimulus deal.
Yeah, that's a very interesting and kind of seductive, but a little dark thesis. So, for your viewers, a normal election year, and 2016 was absolutely textbook with respect to this. Markets are soft between roughly June and October. And there's worry, there's anticipation, there's usually a lot of negativity associated with the actual politicking process. And then they tend to firm up right about now, right about 2 weeks before the election, and then they rally through the election. That's exactly textbook what happened in 2016. But there's nothing textbook about the year 2020. Nothing about 2020 has been normal. We had the big crash, obviously due to COVID in March, and then markets have basically been recovering, much more rapidly than I think most people thought they were capable of recovering in the ensuing 7 months. So normally why do they rally after an election? Well, because the uncertainty with respect to who's going to win and who's going to lose is concluded. We know that markets don't like uncertainty, and so they're able to advance forward. But I think in this instance, you may actually have more uncertainty rather than less. Okay, what does Biden with a Democratic Senate do? What does Biden with a Republican Senate do? What on earth could possibly happen in a second Trump term? I kind of feel like there's a lot of uncertainties that may get uncorked from the election. It's really hard to say.
What does that do to treasuries then? Because the assumption I think now is that if you get big stimulus, the amount of funding that's going to be required will inevitably drive yields higher. Is that an assumption that you're going by?
I not particularly. I mean, look, yields are very low in absolute terms. I think the 10-year is about 0.7% currently. So if it was to rise all the way to 1%, that's like a 50% increase in the 10-year rate. If you think about it, it's very, very small, but that's what would happen. I think what the markets have been saying loud and clear for many years in the US and as well as in Europe and as well as in parts of Asia like Japan is they just don't believe it, that the central banks are going to generate inflation basically ever again. They've simply stopped believing it. They claim they're going to try really hard this time to do it, but markets don't believe it. And kind of the more intriguing economic theory, it's not very positive economic theory, but it's intriguing, is that we're in what's called the debt trap. So there's just all this debt, it's accumulating in the system where we're issuing debt as a form of income replacement in the United States and elsewhere. And it's basically very unproductive debt. It doesn't really, lead to more machines or more factories or make us more productive in any way. And so the interest rate actually needs to be very, very low in order to service all of this unproductive debt. That thesis is basically what has been winning for the last several years, pretty much around the world. And I don't see a lot of reasons why that's going to suddenly change.
It's interesting because that debt trap thesis, the idea of adding debt and getting increasingly less bang for your stimulus buck, is exactly a key criticism what the Chinese have done over the past few years, right? So I guess to that end, is American exceptionalism when it comes to stock markets still a thing?
Well, what I think has happened in the year 2020, so America's stock market is doing, among the best in the world. There's a distinction to be made between the digital economy and the physical economy, right? So we're talking to each other electronically right now. I've been running office meetings electronically. We've discovered we don't really need to physically be in the office. We can be, very productive, from our houses. So it's just one instance of the digital economy is unaffected by COVID-19 and the changes in various, social and practical policies that we have. Unfortunately, the physical economy has just gotten, slammed because there's all these things that we can't do. It so happens that the biggest and strongest companies in the digital economy are predominantly American companies. There's a few exceptions in Asia, but the American blue chips, and they're familiar to everybody. Google, Apple, Facebook, Zoom is is a new one now. They're just the dominant names. When you look at the S&P 500, it's really the S&P 490, the name, the non-FANG stocks. They've done about the same as Europe has. It's not too much different. It's really just those superpower digital economy stocks that have done amazing. So, an end to American exceptionalism in the stock market, I'm not going to try to predict that, but it has been quite a run for the digital champions. That's for sure.
I want to talk more about tech in just a moment, but in terms of the long heralded, when are we going to see the rotation into value? What's the signal to you? Because a lot of supporters of Biden-Harris say with them in the White House, you're going to see a more coherent, more consistent, a better handling of the healthcare situation. Would that be sort of one aspect that would make you more confident into venturing into these, opening up and more of the value names?
Well, it's a very complicated topic, and my company, we're a relative value investment shop, so this is very top of mind for us. I think as we speak, value stocks are in the 100th percentile in terms of their relative price to growth stocks. They've literally never been cheaper. But I think a lot of that is due to measurement error. So when you look at value stocks, the criteria to be a value stock is low price to book. That's your number one criteria. So low price to the cost of replacing physical assets. And what we're seeing around the world is that we're leaving the industrial age and moving into the digital age. I know that's very cliche, but that's what's happening. And in the digital age, we're replacing the physical with the digital. We're replacing physical stores with a digital screen that's just electrons with products that you could buy. We're replacing the office workspace with a screen that is us interacting with each other. And as that process occurs, you have kind of a morphing definition of what value is. So is an election going to change any of that? I don't think so. Not really. I do think, just to sound balanced here, you've seen a melt up in the more speculative end of the market. So spec tech is the quick and dirty phrase for that, and it's getting kind of crazy. And these kinds of festivals of love like this, that they do not tend to end well. And people should be very cautious. I think it is a distinct possibility that as we roll into 2021, and hopefully we do get a vaccine in the first part of 2021, you are going to see some higher inflation comps year over year, just because we had powerful deflation when COVID first hit and we went into lockdown. That could spring, yields a little bit, and that would probably be enough to topple some of these like very speculative type of names where there's kind of not a lot underneath them. But it's just really hard to say what changes the growth value dynamic. I do think that it's very stretched right now, but you might also want to be careful about how you're constructing what you believe to be value. And there's just a lot of names. Unfortunately, it kind of looks like they don't have big histories or a big amount of runway in the future for them.
So of course the latest, you would think it was a headwind when it comes to the latest reporting that the Department of Justice is now going hard on the antitrust issues with Google, with Apple, and yet overnight we actually saw Google stock rise. So is there any kind of scenario where the investors don't call the government's bluff? I mean, we know that probably, perhaps that's something that's likely to be accelerated if we do have Democratic control of the Senate.
I think so antitrust is a very interesting area. We were just talking about this in an investment meeting that my company had earlier today. So, the old definition of antitrust is, think about a little town that has one railroad in it, and if you're a producer of cattle or wheat or something, the only way you can get your goods to market is on that railroad. So that's an essential facility, and the railroad cannot deny you access to that essential facility, or cannot tie your access to whether you like buy fertilizer in the company store or something like that. So that's a very 19th century definition of antitrust and how it would work. So in the 21st century, we have Google, featuring search from partners that it likes, partners that it pays money to, paying Apple a lot of money to be featured in the search bar, doing things like that. The funny thing is for consumers, we get all these great search results and we don't pay anything for it, right? It's free. So their argument is, well, what's the harm? How are consumers being harmed? They're not being denied access to anything. So the government has a challenging case on their hands. My understanding under a Biden administration is there are people that would look to prosecute the Googles, the Facebooks, the Apples, et cetera, in two forms. One would be to require interoperability of their digital platforms with people that want to use their digital platforms. Right now, that is done on a more selective and for-profit type of basis. The other thing is to not permit the Googles and Apples and Facebooks of the world to buy these very little early stage companies that have cool technologies but haven't really been able to monetize them yet. They buy them, they glue them into their ecosystems. They're able to then kind of further their strong and monopolistic positions. Now, that's a very interesting theory. I don't know if that passes constitutional muster. You're saying you're not allowed to buy things. I mean, how do you define what's too little for me to buy if I'm a big multi-billion-dollar company? So, I think they're going to try. I think they're going to try to make life harder for the big tech companies. But the irony is compared to a railroad, once you have a railroad in a little town, like the railroad doesn't move. The tracks are there, they're in place, they're not going anywhere. With digital platforms and digital technologies, how we interact them and what we're doing and how they're programmed to work, it's always a moving target. So by the time lawyers are able to put their case together and run it through the courts, you may not really even be able to tackle what you're trying to tackle anymore. So I think it's going to be hard. I think it's going to be hard for them to prosecute these guys.
Brian, before we let you go, are you doing anything at the moment to hedge your portfolio for risk going into November 3rd, or are you really more focused, as I think the course of our conversation has been going, on what happens after that and what happens potentially next year with the pandemic?
Sure. Well, we're a pretty vanilla manager. We're not a hedge fund or anything. We try to buy good stocks and let the business qualities of the stocks that we buy do the work for us. We did take some action in just the last couple of days where some stocks, I'm not going to say which ones, but that we've owned for a while, they're just really getting up there in some of let's say the industrial and the consumer discretionary space. Those have been popular sectors, and we let some names go. So we're allowing a little bit of cash to build. We're trying to avoid getting involved in what we think are trap type of names. So we've looked at, we've considered whether an interest rate catalyst could be a positive for the banks as a for instance. I'm not personally convinced it's enough to merit a big movement of capital in our portfolio. We own some financial companies, but not a huge amount. So my gut feeling is that we may see a lot of volatility emerge after the election, not because something terrible is going to happen, not because it's going to be a contested election, because people will wonder, well, what are we going to get here now? And at the end of the day, what's the biggest issue in 2020? It's the damn virus, and the cure for the virus that's not on a political timetable. It's going to be found in a lab, and rolled out at the speed at which the labs can manufacture vaccines, and that's not something that really politicians are capable of controlling.
All right, Brian, next year, 2021, let's forget about 2020. I think we're all ready to. What's your biggest contrarian call that you haven't seen other people talk about yet?
Biggest contrarian call. Well, I think people tend to be going for the poles to some extent. Kind of keep leaning hard on growth, or go hard on value. I would say maybe you want to ignore both of those clarion calls and go more straight down the middle. There are a lot of vaccine recovery type of stocks that are looking pretty interesting, where it's certainly embedded in the price that eventually there's going to be a vaccine, but when. So if you're looking at things like hotels and leisure, if you're looking at transportation services like Uber, we own a bit of a position there. Things like nursing homes, that's another very interesting area where there should be almost certainly a lot of long-term demand, but there's a lot of fear about whether that's going to be a stable place from an earnings and cash flow perspective unless there's a vaccine pretty soon. We feel pretty strongly there's going to be one in the first half of 2021, and we can't time it perfectly, but that will take a lot of risk out of names like that. So those are interesting areas to go. Whether those constitute extreme growth or extreme value, I'm not really sure.
Brian, great to have you with us. We really appreciate your time. From Denver, Colorado, Brian Barish, President and Chief Investment Officer at Cambia Investors. They're joining us. Let's get a bit of an insider's view as to how Asian investors and Asian markets are positioning themselves ahead of November 3rd. I want to bring in our very own Asia Stocks reporter, Ishika Mukherjee, who joins us now from Singapore. Ishika, great to have you with us today. So you've obviously been talking to money managers, to a whole array of market participants. What's kind of the mood, given that we do continue to see polls pointing in one direction?
Seems to be that everyone's pricing in a Democratic sweep. Biden wins, they keep control of the House, they take control of the Senate. But I think the big question here, like Brian pointed out as well, is if it's going to be a contested election. I think that's what people are worried about the most. Biden is leading the polls, so all seems good. But then you have this hidden group of voters who prefer Trump. And there were studies even by Cloud Research LLC that mentioned that Republicans are twice as less likely to reveal their true intentions during voting over a telephone poll than Democrats. So you do have certain uncertainty about who's going to win, and if whoever wins, whether that election is going to be contested or not. So Bank of America did the survey, and they looked at fund managers who oversaw about 600 billion in assets, and they're most worried about volatility after the poll than they are before because of chances of a contested election.
Right, Ishika, we were talking a little bit earlier about how you potentially hedge the risk going into November 3rd and even for the weeks and months that go beyond that, right? And obviously you've got your usual suspects, holdings of gold, extending your holdings of cash, obviously is the other option as well. I'm really quite interested in increasing exposure to Chinese stocks, because that kind of suggests that the Chinese recovery story is really its own little universe that isn't really impacted by external factors like the US election.
Yep, that's right. So we decided to talk to a lot of money managers about how they're hedging their election risk. And as you said, we've seen a bunch of traditional and unconventional strategies being used to hedge the election risk. You have gold, you have put options against American equities, especially since they've gained so much. And surprisingly, you don't usually see this, but a lot of them mentioned Asian equities because Asian equities are seen as relatively insulated from the whole election. And you have China, of course, as a center of growth here, first in, first out. So that's the sort of bet that people are taking. And after all, the country did grow 5%, about 5% year on year in the third quarter in a pandemic year. So I think it's very much Asia and very much a bet, Asia being a bet on China. Aside from Chinese stocks, we've also seen the Aussie dollar being of interest to hedge the election risk, because when we correlated stocks and US Treasury yields, we saw that treasuries are no longer the risk-off hedge that they used to be. And as you know, the additional fiscal stimulus is really expected to drive yields higher. So Citigroup has said that the Aussie dollar, especially against the Swiss franc, would be a great way to hedge because it's more correlated to stocks, and a slide in the equity markets can be sort of hedged by put options against the Aussie dollar. So yeah, that's the other thing. And they're also looking at reflation plays, looking at value stocks. When are we going to see that big shift to value and cyclical sectors that everyone's been waiting for, right? So I think Janice Henderson and UBS, both of them mentioned that they're looking at these markets, actually taking some money out of the typical tech plays that have been the big ticket names in stock markets this year, and they're moving to, say, Singapore or India. Yeah, that's what we've been seeing.
I want to talk a little bit more about Asia Tech, North Asia Tech in a second, but I'm just going to jump in, Ishika, and bring up our polling questions because I want all of our listeners and viewers to give us their thoughts, put their bets on who they think will emerge victorious after November 3rd. So take a look at this poll. You can see that polling question coming up in front of you now. The question will be, who wins the US election? Very simple. Answer 1, Biden will win. Answer 2, Biden will win, but Trump won't concede, as he has hinted at before. Answer 3, Trump initially wins, but then Biden wins after the counting of postals. Or answer 4, President Trump will win outright and be in the White House for another 4 years. So we'll wait to collate some of your responses there. It'll be quite interesting, particularly as we heard from Brian earlier, also saying that despite all of the theatrics, if you will, from President Trump, he doesn't actually think that there will be a messy transfer of power, or that he won't allow that transfer of power to happen. So Ishika, one of the highlights, I suppose, when it comes to what investors are liking in this part of the world has been North Asia Tech. How does it play into the possibility of, we talk about the bifurcated internets of the US-China relationship, even under a Democratic administration, still continuing to deteriorate, particularly on the topic of tech and IP?
Yeah, so surprisingly, a lot of the people we spoke to mentioned that they're still very much bullish on North Asia tech. That's very much the place to go. Perhaps it's the known for the markets right now, which is why they're so comfortable with that space. In terms of US policy, they are expecting, if there's a legislative gridlock, Biden won't be able to make the changes to tech or taxes, for that matter, that he has in mind as easily. So I think that's still a bit further away. And in terms of the US-China tensions in particular, even though Biden has said that he won't really back off from the so-called anti-China stance, money managers, analysts in Asia are expecting him to take a less of a combative approach towards China compared to Trump, and at least a more predictable one based on international relations theory as you know it, unlike Trump's tweets. So they're very much comfortable with Asia tech for now, especially if it's a Biden win.
What are you seeing in terms of volatility gauges in this part of the world?
Yeah, so I think what we're seeing is similar to what we're seeing in the US. Volatility has declined very sharply in Asia. So for the MSCI Asia Pacific Index, it's at about 12. And at the peak of it, which was in March or April, it came to about 45. So that's a big decline you've seen, and volatility sort of stayed at those levels. And I'm talking about historical volatility. But this is similar to what you're seeing in the US, where implied vol for the S&P 500 contracts has fallen quite sharply. And for the CBOE Vol Index, the VIX Index, the October VIX contracts are also showing that market participants are more at ease now than they were earlier in the year. This is sort of in contrast to what bond traders are doing or feeling, because a similar gauge for bonds in general was showing that it's actually peaked the fear of bond traders, given what, as you and Brian spoke about, that yields could rise if there's a big sustained fiscal stimulus in the US. So they're expecting yields to rise. Though JP Morgan has come out recently to say that the Fed will sort of backstop any increase in yields. So fears are a bit unwarranted in that sense. But I think the stock and bond markets are looking very contrastingly different in terms of volatility right now.
And Ishika, given that we continue to talk about the first in, first out, and lots of economies in this part of the world have a better handle over the pandemic situation and are coming out of lockdown in a safe way compared to we're seeing another resurgent, wave of cases in the US and Europe and the like. So does that mean that potentially in this part of the world we see that rotation into value happen quicker?
So that's a key question, honestly, that everyone in the markets, everyone's waiting for with bated breath. I think more than the election, it's the vaccine that's going to drive this rotation. And especially investors looking at Southeast Asia. Southeast Asia has lagged North Asia by a huge margin this year. The MSCI ASEAN index is down 22% this year. Philippines and Singapore are the worst markets in Asia, down more than 20%. And it's essentially these indexes that are made up of value shares, cyclical shares, the so-called old economy stocks that have lagged. And based on my discussions with everyone, it really seems that vaccine news, vaccine development is the next thing to watch for this shift to value, and for Southeast Asia, for example, to see some shares flows instead of North Asia.
All right, so much like really the rest of the world continuing to watch for the vaccine. Ishika, great to talk with you as always. Ishika Mukherjee there, our Asia Stocks reporter, joining us out of Singapore for a view as to some of the views that she's been getting in her reporting there. All right, let's just get you a quick look at the results of our audience poll. Who will win the US election? Biden will win, coming in at 22%. Biden will win, but Trump won't concede at a massive 45%. So about half of you actually are anticipating or bracing for more volatility with a messy transfer of power there. Trump initially does win, and then Biden wins after the counting of postal votes, and just shy of a quarter of you saying that Trump will win outright. So some pretty interesting views there. I'm going to bring in, for her views, our next guest, Kathy Matsui, who's the Vice Chair of Goldman Sachs Japan, who joins us now from Tokyo. Kathy, always great to see you, and we really appreciate your time. So just picking up from my conversation with Ishika, there's lots of good news going on and good narratives happening in this part of the world. So should Asian investors be less focused on volatility and watching what comes out of the US election and more focused on the stories that are in this part of the world?
Well, I think you have to basically focus on both, right? At the end of the day, most Asian economies and markets aren't solely driven by domestic drivers. There are a lot of economies that are still very open, and that means a significant dependence on the US, European markets for end demand for the products and services. So I think investors still need to look at both. Having said that, as you rightfully point out, there are some significant, I think, potential positives that are supporting outperformance, not of all Asian markets, but of particularly the ones in North Asia. So, for instance, while we're not in a position to predict, the outcome, of course, of the United States elections, if, for instance, under a scenario where the Democratic Party does accomplish a so-called blue sweep, winning both the White House and the Congress, or controlling both houses of Congress, we believe that there is a decent chance that North Asian markets i.e. China, Korea, Japan, Taiwan, could outperform for the foreseeable future. Why? Because all of those markets clearly have a very high exposure to the U.S. I'm sitting here in Tokyo, and if I just look at Japanese companies that are listed, you see an average at least 12% exposure just to the U.S. Market alone. So I think it would be dangerous just to ignore what's happening in the U.S. and with the political environment there and just solely focus on domestic factors in the region. I do think you need to balance, both things. But in the aggregate, under such a scenario that I just painted, I think that could bode well or provide a bit of a tailwind for those markets in the region that are very heavily weighted towards cyclical sectors like the ones in North Asia.
So the topics, for example, actually outperformed pretty much all global equities in the aftermath of the 2016 US election. And we do expect really Japanese assets to follow most in lockstep with the US, right? So what are the opportunities now, particularly as even if you look at Japan and stocks there broadly, there's a lot more value to be found there in a lot of the other overpriced markets.
That's correct. And it's interesting because if we look at most of 2020, frankly, Japan was, for the most part of this year, a significant underperformer until actually very recently. So true to kind of its reputation, Japan tends to be the tail that's wagged by this global cyclical dog, so to speak. The Topics Index has the highest ratio of so-called cyclical stocks compared to other developed markets like the United States and Europe. So hence, if the outlook for the global economy is deteriorating or weak, Japan tends to underperform and vice versa. Given, I think, the market sentiment or expectations around the U.S. elections, but more importantly about what might be coming through in the form of U.S. fiscal stimulus, has sort of turned expectations about growth around. You look at consensus growth expectations on Wall Street of most sell-side economists, they've definitely been turning upward, reflecting that anticipation of additional fiscal spending, post the election. So with that turn in sentiment, Japan, being very cyclically so-called geared, has actually benefited, and I believe it outperformed many world markets from the month of September. Having said that, though, we find that many of our clients are still extremely lightly positioned in Japan. And not only that, but the exposures they do have to this stock market in Japan tends to be more growth, meaning, the kind of stable growers, defensive plays, the ones that are frankly quite expensive relative to the rest of the market that's trading 14, 15 times PE, about 1.2 times book. But I think now you're beginning to see people get a little bit more focused on diverse plays within the Japanese market, i.e., after all, if 70% of the market is cyclicals, but I don't have that exposure, I'm going to buy what I don't own as opposed to what I already own. So we have a lot of inbound inquiries about, so what should I be buying in the cyclical space? Should it be financial? Should it be autos? Should it be tech? And that's where we're getting a lot of queries in the last few weeks.
Then what is your answer to someone who asks, well, should I be buying or should I be holding off on buying some of these sectors that could be impacted by whoever is in the White House after January next year? For example, pharmaceuticals in Japan that might be impacted by an effort to bring down drug prices in the US, or infrastructure names that could be impacted by, some sort of spending drive under Biden-Harris administration. Do you hold or do you kind of get in before the others?
So, obviously, I think it's very hard to build a portfolio, in anticipation of a pretty, quite a binary outcome, right, on November 3rd. And so our recommendation to clients has been to own kind of both ends of that barbell. So on the one hand, we are overweight the so-called growth parts of Japan. And under the new Suga administration, he has just established a digital agency. It's still a bit premature to figure out exactly what that agency's remit is going to be, but we believe it is all about improving productivity, efficiency in both the public and the private sectors. Hence, we like the technology related theme that doesn't just go for hardware and software, but it also goes to IT services companies, which I think will benefit quite greatly from that new initiative. At the other though end of that barbell, we do recommend cyclicals, and we've been lifting our cyclical exposure basically from the summer. Specifically, we are overweight machinery stocks, steel, automobiles, and within financials, we also like insurance as well, given what we think might happen to the yield curve globally from now on. So I think it's probably appropriate to have both ends of that barbell going into the elections, because again, in 2016, who would have guessed, right, the outcome that we have today? So we think we should, have those risks appropriately balanced.
At what point do Treasury yields rising start to have an impact on the market, particularly if you buy into the assumption that a big fiscal stimulus in the US is going to have to be funded, and that is going to drive yields up higher? We did see that sell-off start in the session today in Asia, actually.
It's a very good point, and we are also getting more questions from clients about this very issue, and that is given the, frankly, enormous amounts both of quantitative easing, monetary easing, combined with very expansionary fiscal spending across the world over, when is it, quote, payback time, and when is the cost of capital actually going to begin to normalize? We do predict, our U.S. economists do predict that the 10-year Treasury yield will go above 1% by the end of this calendar year and rise slightly further into 2021. We also think that under a blue wave scenario, if it were to come to pass, that the timing of the Fed's first rate hike, we would say right now 2025 under a baseline scenario, but under a blue wave scenario, we would see that brought forward perhaps by a couple of years. So clearly this is on top of people's minds. So what is going to happen to this very robust, long duration bull market expansion globally if the cost of capital really starts to rise in a meaningful fashion? And what we say to that is, at the present or for the foreseeable future, we think that interest rates in absolute terms are still so low relative to, say, dividend yields on equities or other sort of assets to compare with. We do not believe, in other words, that yields are going to shoot up quickly anytime soon to act as an obstacle for equities to climb higher. Certainly, it will feed into everybody's valuation models, and we, of course, have to take that into account. But we think, given how low they are in absolute terms everywhere in the world, I think probably has to get well above 1%, maybe 2% plus, before it really starts to impinge on people's valuation models. And I think we've seen that actually several times in Japan's recent history, or the last 2 or 3 decades, whereby yields have been so low, and then when they go from 0.5 to 0.8, everybody gets very concerned and freaks out because, oh my God, interest rates are going in the opposite direction. But when we compare that absolute yield amount to what's on offer in terms of equity dividend yields or other things, then it doesn't seem to impede the upside to stocks. And I think that sort of sweet spot is likely to continue, at least for the rest of 2020.
So you think that the Fed will kind of allow the settling in of that sweet spot, as opposed to the scenario where we get a vaccine and we get a pretty good or an acceptable take-up of a vaccine and the world opens up again? Is that enough of a trigger for the Fed to start tightening sooner than the 2 to 5 year kind of expectation that most people have at the moment?
Well, it's my colleagues' view that it will take quite some time to see, normalization of economic activity leading to demand outstripping supply, leading to a narrowing of the output gap, leading to inflation pressures, right? With not just asset prices, but also especially wage inflation. And so it's not to say that this is never going to occur. Of course, it will occur at some point, but we don't think those pressures are going to build that quickly, within the forecastable time horizon for the time being, at some point we will have to worry about it. But to us, it is not enough of a concern to us now to say, okay, let's go underweight equities and go long, government bonds or other fixed income instruments, because we still think there is more upside to be had in equities. And I will add here, we talked earlier about our view that cyclicals in Japan look quite interesting here. And that's actually become a more widespread view among my strategy colleagues globally. Peter Oppenheimer, our European and global strategist, just put in a note recently entitled Time for Value. And it's not to say that we are saying there is a secular shift away from growth 180 degrees, to value. What we're saying is, if the scenario that we are currently outlining, even before knowing the outcome of the U.S. elections, that our our global economists are forecasting today, global GDP growth is going to reach 6.6% next year. That is against consensus of just 5.3%. If that is our baseline scenario right now, then presumably we believe that it would be appropriate for investors to have at least some exposure to cyclicals than none. And so it's not to say you should hold them forever, but if you have very limited exposure to cyclicals, we think you might risk underperforming the market if you only hold defensives, for instance. So that's where I think we are beginning to see all of this kind of sync, right? We have a above consensus global growth forecast. We think interest rates have begun to bottom out. They're not going to skyrocket yet, but bottom out. And as economic activity normalizes and people are looking for ways to get exposure to the upside, we think what's going to lead the upside is going to be more in the cyclical categories than defensive.
What's the biggest threat to the downside then, Kathy? Because we heard from one Bank of Japan board member just today warning, basically saying if you take a look at the resurgence in virus cases in Europe, in the US, this could be something that happens again in Japan, and that would really threaten the nascent recovery that we're seeing. Is that something that's top of mind for you at the moment?
Absolutely. So clearly, much of our recovery scenario for 2021 is founded on the assumption that there will not only be approval of at least one vaccine sometime, hopefully by the year end, but also importantly, distribution of that vaccine or vaccines pretty broadly and widely through 2021. However, if we end up facing a quote second or third wave that becomes, that triggers yet another round of very severe and strict lockdowns in many major economies, then of course that's going to put a damper on the whole growth scenario that we've been forecasting for 2021. And of course, it will also call into question, is what governments have dished out so far, meaning in the form of monetary fiscal expansion, enough? Will they have to go back to their drawing boards and draft more stimulus plans, small, medium-sized business support plans, employment subsidies, all of that all over again? So this is a crucial assumption that we're obviously making in our forecast. So we need to be mindful and watchful, particularly as we enter the winter months ahead.
I want to get your views on the yen, because you take a look at dollar yen options at the moment, it's suggesting like a pretty unremarkable November 4th in Asia in the aftermath of what polls are assuming to be a clear-cut win for Biden-Harris. Is that an assumption that you're going on, or do we see kind of an awakening of volatility closer to that day?
So we've looked back at past U.S. elections and the dollar yen, how it's traded around those episodes historically. It depends on, of course, how many election periods you take, but we have seen some trend towards, let's say, dollar strength, yen weakness coming out of those elections, but it isn't very clear cut at all. And so for the time being, our Forex team thinks that the broad trend for the USD is for broader dollar weakness generally, which is frankly why we're actually relatively upbeat on the renminbi under a blue wave scenario. But I think vis-a-vis the Japanese yen, yes, there could be some further appreciation of the yen under a blue wave scenario, but we do not believe it will exceed 100 to the dollar. Frankly, Japanese exporters have experienced in the past, as you know, upwards of 85 and beyond against the dollar. Of course, if we penetrate 100, which I think is a psychologically crucial level for the yen-dollar rate, that could send alarm bells ringing throughout exporters in Japan. But I think for the time being, at least from a current account balance perspective, from an interest rate differential perspective, from a portfolio flow perspective, remember a lot of Japanese institutions are still so yield hungry. They can't find that yield at home, so they keep flowing their capital abroad in search of those higher yields. I think all of these sort of competing forces are probably going to, in our view, allow for the yen-dollar rate to remain kind of relatively steady around the current 105 level. And that's what we're using, frankly, for our profit forecast as well for the market.
Kathy, what's more important in terms of an anchor for this part of the world? The Chinese recovery story, the direction of the yuan as an anchor currency for Asian EM, or is it still the direction of the greenback and what comes after November 3rd?
Well, I think that it's probably for most of the region's economies a combination of both. What is the path forward for both the Chinese economy as well as the U.S.? Are we truly headed into a normalization of economic activity? Clearly feels like China's already kind of well into that phase, but is it going to stick, number one? And for the United States, the numbers on COVID cases seem to be getting better for a while, and now they're getting a little bit worse in some parts of the nation. But the markets don't really seem to be phased about it, so far. So maybe it's nothing that we have to be worried about. But again, what happens after the elections? What happens on stimulus? How much stimulus? We also know there may be, tax hikes down the road, of course. When is that timing going to occur, particularly for corporates in America? So I think for most markets, and particularly Japan here, they're looking at both, right? U.S. economy / policy direction, and the same thing for China. I think because of the two largest trading partners for Japan, they are clearly going to be the most crucial factors investors are going to be watching on the macro side.
And it's almost I'm certainly quite curious because, of course, Japan has a new prime minister. He is someone who's very domestically focused, right? He's someone who gets things done. He's a former cabinet secretary. He's not known for his foreign policy or his foreign policy overture. So how closely will you be watching that relationship as a traditional ally develop either with President Trump or with a new US President Biden?
Mm-hmm. Mm-hmm. So I believe that there is a perception about Prime Minister Suga that he doesn't speak any English and he's just going to stick with his knitting at home. But look, just a few days ago, he was in Vietnam. He's on a whole Southeast Asian tour. And why is he doing that? I think it is to show and to demonstrate, that this part of Asia is super critical for Japan and Japan's economy. There was also, I believe, a type announcement between Vietnam and one of the Japanese utility companies, for instance. So I think the intent here, at least from the Japan perspective, is to deepen the ties between Japan and Southeast Asia. Because look, Japan cannot be solely dependent on just the U.S. and China. It has to diversify. It's already had long-standing relations with Thailand and parts of Indonesia, et cetera, but it needs to continue to invest in those relationships, which is, I believe, the rationale behind Prime Minister Suga's recent trip. Having said that, though, clearly, if you ask, Prime Minister Suga, what is the most important bilateral relationship for Japan, it is without a doubt the United States and that security relationship in particular. So to be clear, I think that Prime Minister Suga will definitely, from a very early stage, whoever becomes the new president in the United States, really reach out, invest time, invest energy, invest resources into ensuring that most important bilateral relationship, not just economically for Japan, but most importantly geopolitically for Japan, is as tight as water. So I think that's really going to be the focus. but right now it's sort of in limbo, right? Not clear, who he should be talking to. So just waiting for the outcome, and then I think really investing. So I think that's going to be super important for him. But let me also just talk a little bit about his domestic, because I'm not sure how much people outside of Japan are actually aware of what he's planning to do within Japan. And you're right, he was cabinet secretary under Prime Minister Abe. So he was actually the guy behind the scenes implementing a lot of the so-called, Abenomics reforms. He just didn't get credit for it. It was his boss who got credit. But he is going to continue to carry forth that agenda of reforms going forward. So, for instance, Mr. Suga is very passionate about the improved productivity. I talked about the new digital agency, but besides that, under Prime Minister, there's a big push to improve Japan's corporate governance standards, which we all know were subpar for many decades. And a lot of investors have asked, do you think that emphasis is going to change under Suga? And my answer is absolutely not. Why should it? Because Suga was actually behind a lot of this to begin with. He's been very vocal about the need to rationalize regional banks. He's been very vocal on, why are cell phone charges so much higher than the rest of the developed, putting pressure on that sector. He has invested so much of his time historically into relationship building with the bureaucrats, ministers. He knows that just saying something won't get it done. He has to explain, he has to build that sort of political capital, so to speak, with these bureaucracies before he can implement change. So I would just say, I think there's a significant degree of underappreciation about Mr. Suga and what his intent is. Of course, we need political stability. We need him to stick around for more than a year, and we shall see that play out beyond next September. But assuming he sticks around, I think don't blink is my suggestion. I think that this guy is going to be after better corporate governance. It's also about regional growth and reviving the regional economies. He was the architect of inbound tourism in Japan. And he's also, by the way, very open to immigration and foreign workers, which we all know is desperately needed. And by the way, he's also a supporter of womenomics, right? My pet topic, which is to improve gender diversity. So most of the topics he's pushing are friendly, which is, again, foreigners don't have a lot of exposure to Japan. Not only looking at cyclicals, it might benefit from a cyclical uptick in global demand, but also look at some of these reform area beneficiaries, which I think are probably more interesting from a longer lasting perspective.
Kathy, I have to ask, this is maybe going off the topic at hand, but it really does sound like you're a lot more bullish on Prime Minister Suga than you were on Prime Minister Abe.
Well, I don't know if I intended to come across that way, but I think that maybe it's because of expectations. There was a high degree of expectations right out of the gate when Mr. Abe came into power, if you recall, right? Foreigners just couldn't have enough of Japanese equities. It was euphoria universally for Japan and its new leadership. Now it feels like, we don't really know much about Suga-san. He, just doesn't look very, frankly, prime ministerial, some people say, and the expectations are, I think, completely the opposite, really, really low. And maybe that's appropriate. We think it's not. And so that's where I think there is a disconnect between expectations in the market and what might actually be delivered. But don't get me wrong, none of the stuff that I've just outlined is going to be easy to execute. It is tackling, very ingrained regulatory, legal. He's been fighting the agricultural lobby. Farmers are one of the most powerful lobbies in this country. So none of this is going to be a piece of cake. He's going to have to fight extremely hard. And again, he absolutely must try to strive for stability in his own position to execute any of what I've just said. So that's first and foremost has to be his priority, is to stick around.
Kathy Matsui for Prime Minister next, I think, in Japan. Kathy, always great to have you on with us at Bloomberg. It's a pleasure, and we really appreciate your time. Kathy Matsui, they're the Vice Chair at Goldman Sachs Japan. Of course, we want to thank all of our guests who joined us today, including Brian Barish, President and CIO of Canberra Investors, who joined us from Denver earlier on, Dingy Pan, delivering that opening address on behalf of IG Asia, as well as our very own Ishika Mukherjee, our Asia Stocks reporter, giving us that great broad view as to what Asian investors are looking at going into November 3rd and beyond. So hopefully we've brought you some of those answers. A little bit worried about how most of you feel, about half of you think that we're setting up for a confrontation come November 3rd and November 4th here in Asia, with expectations of a contested election result. Hopefully it is more smooth sailing than that, but I hope you've enjoyed today's conversation. I certainly have. We really thank you for your time and joining us today. And just before you go, please do also fill in the post-event survey that comes up right after the live feed finishes. We really appreciate your feedback, and of course do join us for our next event and all of the subsequent great Bloomberg Live events that we continue to bring to you this year. Thank you so much.